Live from the chicken wing capital of the world, Buffalo, New York. You're listening to the Childcare Bridge podcast, your source for the best tips, tools, and tactics on how to market and grow your childcare center, ensuring total domination. Total domination. This is the Childcare Bridge, and this is your host, Michael Tasner.
Hey there, and welcome to this week's episode of the Childcare Bridge. Today is a continuation of our MAST framework where we're talking about marketing, accounting, systems and strategy, team, and sales. And in each of these areas, I'm giving you what I believe, based on working with hundreds and hundreds of centers, seeing the data all day, every day in real time, need to be focused on in different areas. So today I wanted to talk about everyone's least favorite topic, and that is kind of accounting and finance. What are some of the changes that I'm seeing, and what are some of the areas that you need to be hyper aware of for 2025? Now, the good news is that the accounting and finance side is not one of those areas like marketing that is constantly changing and evolving. There's not 25 new ways to be doing bookkeeping and to reconcile your bank accounts. Like it just doesn't change that much. Are there some things that evolve and some things that we're seeing across all the different centers to make sure that they are more profitable 100%? So let's talk about these in really no particular order. So the first one is that I'm actually seeing more and more of our centers outsourcing their bookkeeping, but then having a little bit more kind of oversight with whether it's the director, for example, whether it's an office manager or receptionist, but they're having kind of a secondary person before them to make sure that nothing is being missed. So when we did a survey last year and we listed out a whole variety of deductions and we said, did you have any of these different things? And we listed out all different things. And then the second question was, for each of those, did you actually deduct it against your income? And there were a lot of them that were very easy, black and white. Like, did you buy office supplies, for example, for your centers? And did you make sure that you had receipts and you deducted that? Yes. Like, most of those were like 98%. But then we started to find a lot of things like, did you have a party for the team? Yep, we had a party. Did you deduct the food and some of the costs related to that party? Yes or no? And we started to find things like that were like, well, 30% of the centers deducted that particular expense. 70% had a party and they didn't deduct the food, as an example. And we started to spot a lot of those things. And bookkeeping in general, unless they know all of the various deductions that a childcare center should be writing down and deducting, they're often not going to be able to make certain recommendations. So while I'm seeing a lot more childcare centers outsourcing to me, bookkeeping, not the tax stuff and planning, but the bookkeeping, it's pretty boring. I mean, you're reconciling bank accounts, you're making sure that all the numbers match and debits and credits and all that stuff. It's not overly exciting. But one of the big things I'm definitely pushing our centers to do is to start to have an additional person that is keeping track, and they're more of a kind of expense czar, to where if there are other things that ended up getting kind of deducted that either shouldn't have, or the other way around, that they're kind of keeping tabs on this stuff. Because one of the most important things that I'm seeing the most successful centers doing that we're working with when it comes to accounting and finance is once a quarter, they're having a tax/financial strategy meeting. And this is not a let's just look and review at our P&L. This is more about how are things shaping up for the year across all the different locations. Are we having any potential challenges? How are we from plan to budget and actual? Have we deployed certain strategies on the tax side? Do we have an accountable plan, for example? So there's certain things that you need to make sure that you're working with someone at a higher level, because by the end of the year, it's just too late. It's just too late. And I can post a link, more than happy to, of all the different things you want to make sure that you're deducting. But I'm definitely starting to notice a trend of people hiring kind of higher level people and kind of like a fractional chief financial officer, but on a much, much smaller scale. Now, the other thing that I'm really starting to notice is the amount of demand from parents to be able to pay electronically and start to pay with credit cards. Now, a lot of centers have been very, very resistant to wanting to take credit cards because of the fees, or they just don't know how. But if you have other centers that are willing to take a credit card, and you're comparing apples to apples, and most centers are never apples to apples, but let's say you're a traditional childcare center, you're comparing yourself to a traditional center, and the tuition is pretty similar, but this location is willing to ding your credit card once a month, and you're not, you say, well, no, we take cash or check or money order. Those things are starting to sway people. Now, what do you do with that 3%? So, Michael, our margins are already thin. Parents have no problem paying that particular credit card fee. Here are the options. Option A is you can pay with a check, and it's going to be what's called $1,000. Option B is you're going to add $30. $30? Like, are you crazy? No, it's going to cost us $30 to ring this credit card, and we're really trying to do our best to keep things affordable for everyone, and we can't afford to absorb that. So we're happy to offer this as a convenience. So we're passing that fee on to them. You're not absorbing it. A lot of other centers say, well, it's really hard to get this stuff set up. We can have you set up and running in less than 3 days. It's actually very, very easy. I could argue the exact opposite. It's almost easier to do this than it is to be taking checks. Checks are taking longer to clear. We can know if money went through in a credit card in 15 seconds. So I continue to see parents demanding being able to pay things electronically. We're definitely not at the place where parents are asking to pay in crypto, but could that become a reality in the next couple of years? 100%. At the time of recording this, we have a new president, and he's one of the most crypto-friendly presidents ever, if not the most crypto-friendly president ever. So do I think, without going on a big tangent, that crypto is going to be another means of paying for bills and things like that? 100%. But if you're that center that is only taking check or cash, you're going to want to make sure that you get a system and process in place to start taking credit cards to make this a lot easier on you. To me, it also makes the record keeping a bit easier as well. You can also have it where, parents can, upon check-in, they could be getting a little notification that pops up on the iPad to let them know that they're past due and they can pay their particular fee, the payment right there. Like, there's a lot of ways that you need to make it more convenient. Convenience is the name of the game for 2025. Now, when I look at, well, what else is really changing in the accounting side, and what else do you need to be hyper aware of? Obviously, you need to be managing your centers with looking at the data. What are the key performance indicators telling you? You've got to make sure that you are focusing on profitable ratios. What are your most profitable classrooms? Where are you leaving the most money on the table? Just had a conversation with a center owner of ours that has, I think, 10 locations. So let's look at the priorities. And we looked at it based on ratios and which locations need more enrollments. And we honed in on actually after school care. And we said, well, if we're able to get the after school care numbers up to X, that could add about $1.2 million in revenue per year across the center, across all their locations, 1.2 million. So this notion of profitable ratios, a lot of centers, they're just enrolling all the time with whomever is kind of coming. They're letting the parents, the families dictate, well, do you want to come Monday, Tuesday, Friday? Do you want 2 days? And you can pick any 2 days. You need to start putting yourself first, which we're going to talk about in just a second. You need to know your numbers backwards and forwards of what's going to be the most profitable for your centers. Our infants, in some cases, infants are among the most profitable. You got that 1-to-4 ratio. You can be charging $2,000 a month and paying somebody $18 an hour, for example. Again, you got to look at everything holistically. And other centers, if they're only charging $700 for an infant, is that your most profitable ratio, your most profitable classrooms. So you need to think about that as you go throughout the rest of this year of where do we really want to be focusing our attention? What new classrooms as we're expanding? Should we be adding pre-K? Should we add another infant room? More space for toddlers? Should we beef up the after-school care? Can we take school age? There's a lot of those different things that you really need to be able to think about and analyze the profitable ratios. But the final area that I'm really finally starting to see our centers starting to adopt this, I wish I could take the credit even though I've shared this every single year for the last 4 years, is this mentality and way of bookkeeping and managing your money called profit first. One of the biggest challenges in this industry is that center owners have this perception that they shouldn't be making really good money. They feel that they are doing a service for the community, which you are. They're like, well, I love what I do, and that's, I want you to love what you do. However, the king and queen eat first. You need to be taking profit from the business before all of your other expenses get paid. What ends up happening, unfortunately, is money comes in. Let's say it's $100,000 for that month. Let's say you've got $1 million a year. That's one of your locations. So $100,000 comes in, payroll goes out, lease payments, all these other payments. And then you look at what's left and you try and grab some scraps. Instead, the whole concept of profit first is that $100,000 comes in and you're going to move, let's call it 5%. So $5,000 goes into a separate bank account that has nothing to do with the business, and that is your profit account. And it might not be 5% right off the bat. Maybe it's 1%. But you get into this habit of pay yourself first. It's the exact same concept for the business, but what ends up happening is you bring in all this income, but then all the expenses take all your money. And magically, regardless of how much you have, it seems like there's always more expenses. There's always another tool you can buy, or an event you can go to, or another seminar, or something else. The classroom, you need to retool that, or the playground equipment. But what I notice and what I love about childcare center owners is that if the money isn't there, they're normally not going to be massively overextended. So if the money already gets yanked out to you first in this profit account, you start to get in the habits of you've got an income account, you've got your profit account, you've got an owner's compensation account, a tax account, and then your operating expenses. So you need to make sure that you're moving the money into all these different accounts. And I'm oversimplifying, but you're moving money so that you actually are moving the needle for you and your family before everything else. Now, while money isn't the number one motivator for most owners of childcare centers, it's definitely demotivating when you're not making any money, you're not taking a salary, you've got no profit, and you're stuck. I've been there. That mindset, that headspace is absolutely terrible. Profit first. That's the strategy that I want to see you deploying this year. You will be happier. You will be just in a much different spot, a much different relationship with money. And if you stack all the other things that we talked about, profitable ratios, really analyzing those numbers, making sure that you're charging the tuition that not only is your center worth, but what you need to be charging to be able to take a good salary and to be able to take profit. I can't have you charging bare bones tuition. Charge more. You want to lose all your enrollments, or do you actually want to stay in business? Most centers are operating at levels of profitability and owner's compensation that are literally at poverty level. Charge more. That's what I've got for you by way of accounting and finance. Now, the good news is there's not a whole bunch of new stuff. It's leveraging some type of fractional CFO, for example, to do your strategic planning every single quarter. Having outsourced bookkeeping, but having someone else internally making sure that we're keeping tabs of everything so we're not missing deductions. Having those profitable ratios and really analyzing, is this an enrollment that we actually want? You don't have to take every enrollment that comes through the door. And then finally, deploying the concept of profit first so that you and your family eat before everything else. Get out there, start taking your profit first. Make sure you tune in next week. We're going to be talking systems and strategy as we continue throughout this process of the MASS framework. Michael Tasner signing off. Good morning, good afternoon, and good night. I'll see you next week.